I would ask our first guest, Bridget Neville from Capital One Bank, to share with us, some of the factors and variables and indicators that the bank looks at. And just very quickly, Bridget, who has come up to us from as far away as Houston, Texas, and she has over 24 years of banking experience, providing consulting with the emphasis on real estate to Capital One, 20 years with Capital One Bank with commercial real estate portfolio management, and various other positions in markets from South Texas to Northeast markets, the Houston area, New York, New Jersey, Philadelphia, and Connecticut. So she's a very smart gal, and she's come a long way to be with us. So please welcome Bridget Neville.
I would like to say thank you for inviting me. Vinny Mutarelli and I have worked together for several years. I've been covering the New York, New Jersey territories along with Connecticut and Philadelphia most recently. But I've been covering the market since 2009 and have had a lot of opportunity to learn about the various sub-markets within the community as a whole. Most of my time is actually spent in the boroughs, as well as New York City. I spend time in Long Island, as well as learning communities throughout New Jersey, especially the south side of New Jersey leading into Philadelphia, as well as spending a lot of time with Vinny in the markets north of Manhattan and going into Connecticut. I wanted to share with you, I guess, kind of our little formula to answer Albert's question, how do bankers think? We don't have enough time for that, and I prefer that you not render me unconscious either to make any decisions. But basically, we actually focus a little differently on each type of product. And I know with this particular audience, we are here and focused on our real estate aspects for credits. So to kind of demystify our process in our investment real estate department, I wanted to provide some highlights to you. And that starts off with me actually sharing a little bit about Capital One and the products that we provide. So as I mentioned, I work with Vinny, and Vinny is one of our senior business bankers who is engaged in the community and has always brought a lot of insight on any project that I've worked with him on. The types of projects that Vinny and I have partnered on have varied, and they include multifamily, office, retail, industrial products, self-storage, as well as mixed-use facilities. And what I've learned is that in each market, there's a different need and a product that thrives and varies. Overall, for Capital One, the way that we approach investment real estate lending is looking for a stabilized, well-managed, well-maintained properties. But we also have opportunities to transition properties, and we have products for non-revolving lines of credit that are utilized to do tenant improvements to existing properties. Also, in limited situations, also to finance ground-up construction in products that have a very high demand. We offer services from the onset, from the initial contact, from visiting with prospects, meeting folks in the community, going out to find the people, not only who are the developers and the investors, but also the people who service them. And that can include your appraisers, your title companies, your CPAs. So we spend a lot of time trying to reach out to the community and share our services and get the word out. And then once we actually make that connection and a prospect is converted into a customer, we have services at Capital One that actually stays with you for the life of the loan. We're not just trying to do one-off transactions to develop business. We're trying to actually invest in our communities. So by doing that, we have several layers. I, for instance, am the relationship manager servicing your market, and I'm always in the background on any loan from the onset, working as your liaison in the bank, trying to streamline the process, assisting bankers like Vinny in executing a process to get you a swift reply to help expedite your business transaction. And after we've approved it, helping in the background with the closing to expedite through our loan closing processes, as well as working with the attorneys that'll document all of your loan closings. And then in the background, we also have a full construction monitoring team that's available to assist. Now, the types of products, I'm not really pitching Capital One products right now, but to demystify it, I have to tell you the types of credits that I take a look at, right? So we offer term loans that are available for refinancing existing credits. We also offer non-revolving lines of credit, and we also have a secured revolving line of credit. Those are utilized for different purposes. The revolving line, for instance, can be utilized for acquisitions of new buildings while securing it with a stabilized project in your portfolio. It gives our customers an advantage in the market to be competitive and bid quickly when they're in a competitive situation on acquisitions. Our non-revolver, as I mentioned before, it's often there to assist in improving the actual physical facilities. And our term loans can provide you cash out that you may need for various business purposes, and also to refi existing debt. Now, how I wanted to pull this into the community and show you really what we're looking at is that we spend time, including yesterday, I was at the New York City Real Estate Expo. And one of the sessions that I had the honor of attending was actually focused on opportunity knocking in Westchester County. And I thought how appropriate I can actually get more information than I even thought I had to start. We like to look at the submarkets. So we don't just look at stuff and say, oh, I'm comparing it to the multifamily market in New York City. Or I'm looking at projects and comparing the values and the rental rates and the sales prices to Philadelphia to Yonkers. We try to hone in and provide an intimate service, but also look at our properties on a case-by-case basis, understanding what our investor or developer needs are, what's going on in the community with the type of products that they service, what's driving that. And everybody knows the cliche about location, 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 but it is truly applied. So for us, this tells a big story, just showing that map, is identifying where you are, where's your access by waterways, by trains, by highways. What are those sub-communities that make up the greater Westchester County? I thought I would just put some information in there that I've taken from one of our appraisers, so if you happen to recognize your wording, it is your words and not mine, should that appraisal company be here. But basically, Northern Westchester, for instance, if we had products there, I tried to highlight some of the things that we would look at in understanding what's going on in that market. I thought keywords were low density area, more rural, actual good access that has been improved going north over the years, that is also creating opportunities for development, for residential opportunities, or that be industrial opportunities. Yesterday, I alluded to the time that I spent at the Real Estate Expo, and a lot of time was spent discussing the central Westchester County market and all of the great things that are going on here. In February, I had the opportunity to visit with Vinny and another person representative in the community who was a realtor, who was telling the story for me, kind of prepping me for 2018, explaining the different things that are going along as you have waterfront development coming to your area, as there are more people who are not only commuting to the city from this location and living in probably more of a luxury type of single-family residential need, but also identifying the new businesses and offices and companies that are here that are attracting people to relocate here. And also those people come with new demands. Better access for the trains, which everyone is talking about, the developments, improvements to the train stations, and understanding exactly how many people are coming here who will be looking for single-family housing versus multifamily opportunities, and what are the businesses that are coming looking for. Are we talking about, office condos? What's happening in our medical office space? What's happening with mixed use? So when you bring that greater density to different areas in your villages, what services do we have there? I know there's a lot of conversation now, I'm sure you've heard it, about retail. Those are the types of things that we focus on. Who are the tenants? Understanding that the tenancy is important. In the multifamily segment, we like to identify basically where's the demand coming from and what type of property type are they looking for? What's the unit size? What's the location and the appeal? What's the good access that they need? And where exactly are they working? Where are the dollars being generated from? And what does that overall growth have on the community? So again, each time we make a loan decision, we like to think of that as an investment in our communities and also a development of a relationship with our actual customers. Same for Southern Westchester. I've had the opportunity to work on several transactions in Yonkers, and over the years since I've been servicing the community, Yonkers, the demands and needs and a profile of what it looks like has been changing over time slowly, but I see it as an optimal market to see mixed use and multifamily development that's strong there. We've had some very successful projects that we've worked on. They come in all different sizes. Typically, Vinny and I are working on transactions that service our business banking community versus our commercial real estate community. So those loan needs and the development size of those projects have a tendency to probably range 7 million and below. But we do have at Capital One a broader scope of departments that services a whole lot of real estate needs that I'm not even covering today, with our community development and our commitment to investing as capital investors with community development projects. But we also have our commercial real estate team who will look at transitioning perhaps some of the older office space that's being converted or proposed for conversion into residential and mixed use properties, or entertainment centers, where we're seeing a lot of changes there. And I thought I'd put a slide on what works well with us and try to hone in on some of the products that are a sweet spot. I've mentioned multifamily apartments over and over, and I think in the market, the greater New York City market, and even in the other areas that I cover, that with the density of the population here, that is one of the best products that we've had. Of course, it's always sensitive, like everything in real estate, to economic trends, what's going on, not just locally, but domestically and globally. But we've had great success there. And I think multifamily, just like single family, of course, when you bring people to the area, that's key in understanding how your community grows, how it develops. And we actually have made a commitment to being very competitive in that space. So you say, well, what are you looking for? I've come to you with a request. You're saying that you need to evaluate it, look at my financial statements, and get back to me. Typically, the first thing we ask, of course, is, okay, where is your project? What is the address? What is the location? And I've taken a little excerpt from CoStar. Are many of you familiar with CoStar, by a show of hands? A lot of the appraisals will utilize this data. They're a national database. They also acquired LoopNet, which lists a lot of properties, but they have been a great, quick resource to identifying different properties in various markets. And this one in particular, I just grabbed a property from Yonkers and showed you. This is some of the first things that we'll take a look at. What is that property in understanding its physical attributes? What's the overall condition? What's the number of units? What's the gross building area? What's the net rentable square footage? How many tenants do they have? What's their average vacancy or occupancy? And CoStar does provide a lot of data such as that when they have active and reporting individuals participating who are investors, are realtors in the market. Now, is it a great science and totally accurate? No, but it gives us a good overview of some of the primary attributes we're looking for. So if you look there under market conditions, those are the types of things that we're comparing your individual property to. How is it performing not only as a single asset, what is your cash flow, what's your gross potential income, and your average operating expenses to generate your net operating income? That is the primary source of repayment for our loan, but also how is it competing with the other properties in the market, with your peers, and understanding what's the average asking price in a sub-market that may be a 1 to 3 mile radius, or getting a little bit more in comparison to the larger global market, and saying what's that average occupancy, vacancy, and the average rental rate specific to unit types. In the process, to get started, what we typically do is to give you initial feedback, to say, look, we can, as quickly as possible, assess this and determine generally what we can provide to you by way of loan amount and understand an appropriate product type. So in order for us to do that, the first thing that we need is pretty much a detailed property description. Oh, sorry about that. Your latest rent roll on the property, and your latest fiscal year-end financial statement, our tax return. And with that information, and along with the research that we look at, we compile that info to actually make a determination and an initial offer, a starting point for our conversation. And basically, I've already covered this, but these are the 3 things that I'll leave you with that I think are key in any investment real estate outlook. And being the banker and answering Albert's question about how do bankers think, I will tell you not very differently from the developer. Everything that I've learned about real estate in my almost 25 years of servicing different markets has actually come from my developers and attorneys, not what I've learned necessarily in the bank. We're actually reacting to what our customers' needs are and what we actually need to do to properly document a request. So cash flow is primary, loan to value for us is secondary source of repayment, and then tertiary source of repayment is the guarantor support if that's applicable. But primarily, we like to focus on stabilized, well managed properties with strong cash flow. That's a highlight from the Capital One perspective, and I guess I will call Albert up. I think our Q&A will be later so that he can introduce our next speaker. Thank you.
Thank you, Bridget. My second film, but I'm kidding. I could come up with about 3 or 4 scenes from films having to do with banking, but by the way, before I call our next guest up, Gardner, Semet, I was remiss in trying to get into the program as quickly as I did and talking a bit about our co-op condo legislation campaign. But I don't know if Ken First is still here, but we have to thank Ken First and Jason Scicciano. They just left, naturally. This is like, oh, Jason, there you are. For their sponsorship of the generous sponsorship of tonight's meeting. And, so I finally got it in. Better late than never. Gardner Semet has been an executive vice president at BankUnited since October of 2013. He manages and supervises the commercial real estate loan origination in the New York metropolitan area. as well as deposit gathering and the sale of bank products to owners of investment properties. He's also served as Executive VP and Director of Real Estate Lending for the Amalgamated Bank from September 2010 to October 2013. In that role, he managed and supervised loan origination and the underwriting team in the Commercial Real Estate Lending Division, deposit gathering and sale of bank products to owners. From 1992 to 2010, Mr. Gardner was an Administrative Vice President with M&T Bank, and that position he was involved in also commercial real estate originations, team leader in non-recourse commercial real estate lending, Fannie Mae, Freddie Mac, and Federal Housing Administration originations. So with all that experience, we expect him to talk for at least 5 minutes. Gardner, welcome.
So I think you'll find it easy to understand what I'm thinking. I've been doing this a long time, and I started lending actually at the Travelers Insurance Company in 1986. And along my career, I worked, when he says M&T, it was also the East New York Savings Bank that was owned by M&T. And I've learned from people who were lending even before that. So while I have 32 years of lending experience, I've learned from people who were lending probably back into the 40s. And it's not the oldest profession in the world, but lending money is an old profession. So what happens, I don't really do a lot of this kind of marketing. And my bank doesn't do a lot of advertising. I just sort of, I'm there and the deals come to me. The deals come to me because I've made a lot of other deals. And if somebody brings a transaction to the bank or calls me up, if they tell me an address, if I haven't looked at the building, I know the building next door or the building across the street. So it's pretty simple. Somebody brings in a submission, we take a look at it. Probably in about 5 minutes, I know how much I'm going to lend on. But what I'm thinking about all the time is, I'm thinking about, okay, how does this fit to what I know? And so I try to figure out what the rents are in the neighborhood. Are these rents too high, too low? Is somebody lying to me? I mean, it's shocking to find out that some people are overly optimistic when they report their rent rolls, or overly optimistic when they tell me how low their expenses are. So it's pretty simple. There are lots of standards. Every time you make a loan, and every loan you have in your book, you get a report of the income and expense. So the information's out there. I don't need to go and look at the appraisal because I just look at the 3 deals that are right next door. And you know, we're trying to figure out where we want to be in the market. So when I started at BankUnited, we did 80% of our business was multifamily. Now, as we got heavier and heavier into multifamily, we said, perhaps this is too much multifamily. So we started considering other property types. So we make loans on apartment buildings mixed with retail, mixed with office buildings, parking garages, and we also expanded our area. I like to say we used to make loans where the subway goes. Now we make loans where the trains go. So I come up here to Westchester and I make 3 loans on Waller, North Broadway, and DeKalb. And they're apartment buildings, brand new. Took a little bit more to learn the market, but it wasn't very hard. And now that I have those loans under my belt, I can see, I see other submissions. People say, oh, I saw you did this loan, or I talk about I did this loan, and it just comes to us. Now, when we start looking at other products, sometimes it takes us a little time to understand the market. And so we've been looking at Westchester office space. In the time since I've started 5 years ago, Westchester office space has actually improved. Vacancy rates are down. There's been a lot of conversion of older office buildings, so the supply of office space is down. And we can see that in every submission we receive, where the rents are, what the vacancies are. So I'm always thinking about what I've done in the past and what people are showing me. Now, on a more macro level, I had this dream. There were 7 fat cows eating grass on the side of the river. And all of a sudden, these 7 lean cows came up and ate the fat cows. And I said, what does this mean? And this means it may not be so good for so long. So when I look at a transaction, not only am I thinking about, okay, does this make sense now? But what's going to happen in the future? Now, the future is uncertain. So what I'll do is I'll try to say, okay, how much can the rents come down before the landlord feels real pain and before he makes his pain my pain? So I'm always trying to see what the upside and the downside is in every transaction. Now, I happen to like multifamily because I like to say there are a lot more homeless people than there are homeless businesses. So what that means is that the market will always clear for an apartment. There's always going to be somebody who will take that apartment. The store, the office space, it has to be the right size, has to be in the right location, has to be the right amenities for that space to clear. So sometimes some of the office space and retail is never going to lease. And I don't want to be in those buildings. So I make that determination pretty quick. It's not a hard business, and I don't know if I'm going to get to 5 minutes here, because I think I've delivered almost everything I know about real estate just now. But I can tell you what the other businesses that we're in that are related to real estate, but we've moved to because it offers us a certain amount of security. We love co-op lending. Co-op lending, there's so many more people who have to feel the pain before we feel the pain as on our loan. There's the equity holders, the unit holders, there's the lenders to the unit holders, and the shareholders in co-ops are always making sure that everybody's paying their maintenance. Same thing with a condo association. So not only do we do co-op lending, but we do loans to condo associations, which is a very niche business, and it fits in with trying to protect our downside. Now, the nice thing about lending is we move to where there are areas of unexploited opportunity. So that's why we're doing more commercial deals, because there's not that many lenders, and more mixed use with high percentages of commercial deals. And the margins are a little wider. It's a very competitive business. So at some point when you're not making money doing a loan on multifamily because the spreads are super narrow, you look at other opportunities. So I'm always looking for the opportunities where all the other banks aren't, and also when a customer comes to me, the first thing I ask is, what's the purpose of the loan? Because if the borrower doesn't have a need for the money, I just spend a lot of time running in circles. It has to be, there's a maturity coming up of this existing debt, there's a recapitalization event, the borrower wants to do some improvements, or the borrower wants to take money out to do other real estate investments. So that's the key thing in my discussion. I'm not terribly worried about the particular location, because we will lend anywhere. Every building deserves a loan, and it's my job to figure it out. It could only be $1, but most commercial buildings, there's a level of debt, and I always make the offer. And then I try to structure the loan to fit what the customer needs, because a customer who tells me they want a 10-year loan at the lowest rate, and they go out and get it, and the loan has yield protection, it's called yield maintenance. I hope everybody here knows what that is. It basically makes it very expensive to go elsewhere. If they have to do something in 3 years, if they're 94 years old and they want a 15-year loan, I say, perhaps that isn't the best idea. So I try to tailor it to what they need, and hopefully the market respects, when I give them my reasoning, why they want the loan, why this loan works for them. Even if it's a little more expensive or a little less proceeds, they understand it and they'll take the business. Now I have John Haberman here from my bank, who brought me here, and John's part of the group that goes out and gathers deposits. We work with our customers to bring in deposits and lend money. It's called the VIG. That's how we make a living on the VIG. So it's, like I said, that's an old business, and I think it's been pretty evident in my short talk about what I'm thinking. And if you have any other questions about what I'm thinking, I'll be happy to answer them later. Thank you.
Yeah, I'll be there.
There is a Neapolitan equivalent to your dream about the 7 fat cows and the 7 skinny cows, but I'm not going to go there. Our final speaker on our panel, actually, he was very gracious to fill in for a third scheduled speaker who unfortunately couldn't make it tonight. But we have Jim Lanfranchi, who is the Senior Vice President and Relationship Manager with Webster Bank. And Mr. Lanfranchi, I think, as everybody, be with over 30 years of experience, so how's that? In financial services, including loan origination, insurance, investments, credit analysis, and real estate appraisal with a number of well-known groups, MetLife, Citibank, Fleet Boston, and so forth. He's on the board of directors of the Business Initiative Corporation of New York, an affiliate of the Bronx Overall Economic Development Corporation, as well as the Hunts Point Economic Development Corporation. And by the way, even I am coming around to the realization that the Bronx is really hot. And the Bronx, I like to think.
Vinny knows that as well.
Well, actually, I learned that from Vinny, and I like to think it's because of the Yankees, but I'm sure there are other factors involved. He is also treasurer of the Bronx Rotary Club and vice president of the Sons of Italy. I didn't know that. Sons of Italy American Calendar Lodge. So without further ado, he's also going to talk for about 5-6 minutes.
Yeah, less than that.
Less than that. And
They said it all.
And then we'll take questions. Jim?
Hey, thank you. All my colleagues have the previous speakers have said it all. Although Gardner said something that really jumped out at me. And he was talking about multifamily lending and how much, you know, the focus on multifamily lending. And he said, you know, there's more homeless, what did he say? More homeless people than businesses. Nick Marrow is my boss. He's not here. Nick Parisi is here, who also works for Nick Marrow said many years ago, nobody's tearing down apartment buildings to build factories. And Webster Bank is, I spent the last 5 years at Webster Bank. That's why I work in the South Bronx and work on all those economic development boards, because we believe and we offer rates similar to those rates that you would get on a multifamily project on those, you know, nasty looking mixed use properties that I get sometimes, and factory buildings. Oh no, I wasn't talking about your deals, Jerry. Jerry, your deals are all good. No, it's just a matter of there's a lot of other properties out there other than multifamily, and Webster tends to lend to places. We've actually cut back on our multifamily lending. I think everybody here has cut back on their retail lending. Not a big fan of retail, although when I came here 5 years ago, to Webster Bank 5 years ago, I said, they didn't like a deal I brought them in. It had a nail shop, a pizzeria, a Chinese food place, and a bodega. And they were like, look at all these crappy tenants. I said, yeah, but okay. Those crappy tenants have been there for 40 years in one shape or another. And you can't get pizza on the internet. And if you want your nails done, you gotta go to a place to get them done. So those are places that are never going to go away. I just want to say something about the BRI. I've been coming to the BRI for 5 years, and Jason and Ken have always been here. If you're not getting your insurance there, you should. But thank you very much. I wanted to make sure I thanked you for sponsoring this evening. I see a lot of the people that we work with on a regular basis, and I hope you do too. Jerry Houlihan, if you're selling or managing, if you're going to get your elevator serviced, you got to go to Judy at D&D. And I always get my title work done with Kenny. Kenny Messina, statewide title. What does Webster Bank do that's different? I know what Nick Parisi and Nick Marrow and I do that's different, and Mike Trainer, who's here also. We really don't focus on one-off transactions. We're not looking for people who are, you know, I want to buy this building, and it's the first question I ask is, well, what kind of experience do you have? Or you're refinancing a building? We're looking for generational wealth management, even though we don't do wealth management. But I'm looking for people who are generational borrowers, people who are looking to pass a piece of property on to the next. They don't need it to eat. They just want to pass it on to the next generation. So we tend to focus on long-term fixed rates.
When I mean long-term, I can offer 20-year fixed rates up to $4 million. We just closed a loan at 4.8%, 4.83, excuse me, 4.83% for 20 years on a $4 million loan. And it was all about generational wealth management. It's all about, I don't need the money now, but I need to pass it on. One of the ways we do that, I don't know if any of the other banks present do it, we do a lot of interest rate swaps. And if those of you who are not familiar with an interest rate swap, the concept of a swap meet is right there, where you're swapping the risk of interest rates changing with a third party. And that third party is going to absorb all the risk of interest rate change. So you can typically lock in a lower interest rate, and I'm saying 40 to 50 basis points below what a similar loan might be in a conventional loan, and be able to transport that loan because it's fungible and you can sell it to somebody else. So for people who are looking for generational wealth management, longer term fixed interest rates, and I also made a note, somebody said interest rates are going up. They are going up, right? Interest rates were low for about 6 years, 7 years, because the Fed was buying, the U.S. Treasury was buying Treasury bonds. In September, they stopped. September 9th, we bottomed out. I think the 10-year Treasury was 209 on that day. And right now, it's close to 3%. So that difference in interest rates was not from the fact that they stopped buying so much as they started selling. So the Fed is now selling $10 billion a month in 10-year treasuries. And every other sovereign wealth fund and central bank in the world that keeps their money in dollars is also selling. So that's going to slowly but surely, I mean, you're not going to dump all your bonds right at once. You're going to just ease them into the market. So interest rates are going to continue to rise. The days of 3.5% on a 5-year or 7-year, that's not going to happen anymore. The days of, so 4.5%, 5.5%. Right now, again, if it's a conventional loan, we're at about 5.25% on a 5-year. Some people might be lower. But that's where it is now, and it's going closer to 6.5% and 7% in a couple of years. So the ability to lock in a long-term fixed interest rate versus that short-term bump you get in cash flow, the benefit is locking in a longer-term interest rate, and that's what we're selling right now. I don't know what everybody else is doing. Last night I had the opportunity to see Jamie Dimon on TV. And if you saw, banks are doing really well. Webster Bank has done very well with the tax law change. You notice that the tax law change benefited owners of commercial real estate. What? Well, if you own long-term commercial real estate, I mean, if you're investment commercial real estate owner, you probably benefited from the law, or you didn't suffer. You didn't suffer, right? It kind of goes in context with the president, who owns a lot of investment commercial real estate. So the object is to conserve the wealth that you have and conserve it for future generations. And the way to do that is to lock in short-term interest rates, long-term interest rates if you can. But what Jamie Dimon was saying, I got off that. What Jamie Dimon was saying was that Chase Bank is going to be opening 700 branches.
70.
70?
70 branches with 700
I'm sorry,
employees.
70, excuse me, you're right. Thank you, Vinny. 70 branches in the Washington, D.C. metro area, and employing 700 people, 10 people per branch. That's where I got the 700 from. And that just gives you an idea of how much money that's flowing back into the economy and what they want to do. If you've ever been down to D.C., all the cranes that you used to see around New York, they're now down in Washington, D.C. Building buildings. It's the new Rome, actually. But For those of you who don't know about Webster Bank, I'm not going to get into it. We've been in business since 1935. Go to the website. It's a fantastic story. It's the story of It's a Wonderful Life. It's about a guy who founded a bank in 1935, one branch, and made a commitment to lending money, taking deposits from the community and lending it back. And that's how we built our business. We'd love the opportunity to talk to you. You know how to reach us. Just pick up the phone and call any of us. Anybody here knows how to reach us. I'd love to speak with you. And I encourage you again to investigate long-term fixed interest rates with Webster or any of the banks here that offer them. Thank you very much for the opportunity to talk.
All right, we'll open it up for questions. Jeff, my colleague Jeff has a mic, and we'll start taking some questions. Anybody want to start the interrogation?
Yes.
Yes, Jerry.
Thank you, everybody, for speaking. So, I guess kind of tail on to what you were saying about locking in long-term interest rates. How are the banks hedging themselves against long-term interest rates with the rise in you know, like you were talking about, the rise in the Treasury constant maturities, the bonds, etc.? How are you guys going about hedging yourselves against it? Are you lending, like you said, you're doing a lot of long-term lending, 10, 15 years. Are the spreads that much different between the 7-year term, the 5-year term, etc.?
As a matter of fact, I call every morning at about 8:30 to talk to the Treasury desk and find out where we are. A 20-year fixed rate this morning, the base rate, what we add our margin to, was 2.86 for 20 years. A 10-year rate was 2.82. 4 basis points for 10 years. For you not to go the extra 10 years, it's crazy. So, and the way we're hedging those long-term rates is what I talked about earlier, is an interest rate swap. And again, an interest rate swap is a variable adjustable rate mortgage where you exchange the risk of an interest rate change, of the interest rate fluctuation, with a third party. There are always third parties who want to buy that risk because they're hedging another bet and they're trading for profit a lot of times.
The other...
So we do floating rate deals with swaps, but what we were just talking about, the yield curve that's kind of flat, there's something called the forward rate. And so you can calculate out what the market expects the forward rate to be 10 years from now, just by knowing the 10-year Treasury rate and the 20-year Treasury rate. What the market's telling you is that the forward rate's actually not going to increase. So it may be counterintuitive for people to say, lock in now, and we disagree, and that's how a market is made. But I have a story to tell. When I was at the Amalgamated Bank, I had a terrible reputation. And so we were trying to close a bunch of loans, and I said to myself, you know what, I'm going to give away my prepayment fees, just so I can get the loans closed and get them on the books. And rates were really low when I started. We were still coming out of the recession. And I said, how much lower can rates go? Well, about a year later, rates went down even further. And all my stuff that's been on the books, people are coming back to me for lower rates, and I had no protection. So we don't gamble on interest rates. We hedge ourselves, and we have a lot of low interest bearing deposits. And what I like to say is that the loan should match what the borrower wants to do, because to unwind an interest rate derivative can be very expensive. So it's all according to them. For generational holders, it's a great idea. They just want to put it to bed, and especially a small loan, because the transaction costs are very high. Because there's appraisal fees, title fees, environmental fees, all kinds of things. And, you know, underwriting fees and things like that. So we're trying not to doing the short term for the little loans. But for the bigger loans, where the costs are very small to the transaction, I don't really encourage a long-term deal unless, you know, the building's not going anywhere, the revenue's not going up, nothing's going to happen. Like, there's not going to be a partnership dissolution. And also, I beg to differ a little bit on where interest rates are going. You know, what scares me is a flat yield curve, or an inverted yield curve, even worse. The long-term rates are cheaper. That means nobody wants to invest in the long term. So, but that's why there's a market in interest rate derivatives, because he's got one opinion and I have another.
And I would share with Gardner that, you know, we've had that experience. We've offered interest rate swaps on our loans, and I agree that it's a product that should be very specific to the needs of the organization and the principals, and understanding the amount of exposure you had. In our commercial real estate department, I too have many stories about us setting those fixed rate options and doing swaps on transactions and thinking the rates wouldn't go lower. And of course, that's what part of it is, right? So you're hedging your bets and gambling, and it can be an effective tool. However, unwinding a swap can be very costly and outweigh some of the other benefits. And you do want to anticipate and kind of project where you are with those additional variables there that would impact your cash flow. But there's also a positive aspect to swaps, and it is the long-term fix on the rate. And when you are winning on that side and in the money, there is a definite benefit, and the right borrower who knows how to manage that risk, who would actually utilize those proceeds when they are winning to actually hold that extra income and be prepared, versus some of our borrowers where that's not necessarily the best fit for you, depending on the size developer you are, what your assets look like, and what your liquidity look like. So for Capital One right now, in the space that we're talking about with our business banking aspects and smaller loans, we do have 10-year fixed rate options. And of course, our commercial real estate department, they have different options available, and we do floating rates on our revolving lines of credits, of course, and pricing with a spread. So I think we all share similar kind of perspective on that, and recognize there are lots of different options out there for you to consider.
Any other questions?
Well, one more, Albert. How do you as lenders look at industrial buildings now with the e-commerce and the Amazons kind of maybe cannibalizing, if you will, the smaller retail properties out there? That, you know, I manage a lot of retail properties, and like you were mentioning, the tenants that aren't in the service sector are suffering because of Amazon and the e-commerce industry. Do you see industrial buildings as something bullish to lend on? Or I'm just curious about that. Thanks.
I'll start. For us, we do look at industrial properties and consider it and evaluate the specific sub-markets and what the needs are. We also look at, in our space for our business banking loans, to do more lending in a flex space area where you're talking about multi-tenant buildings versus having one large facility that's 250,000 or 500,000 square feet. And I've had those types of transactions. If you're not in the right market and that one single tenant with that type of exposure leaves, who's going to reabsorb that space? So we do look at subdividing the spaces and knowing that those buildings are convertible, but also I find in our smaller loan segment that the industrial flex space works well. To address your retail question, of course, all of us did mention that. There is concern, of course, for what the impact is with e-commerce business, but there's a lot to be said, exactly what he indicated about the need for those service industries and things that we considered not the best tenants and stronger tenants. Now we're looking at those local long-term tenants who are operating their businesses there and providing more of a service, but also there still is a need for certain retail. And we look at it on a case-by-case basis and try to evaluate that risk without just saying a flat no. So that's our approach.
Yeah, I guess, yeah, we do that. So industrial is the best product type currently around in the market. Vacancy rates in New Jersey you can't find industrial space. It's true in Brooklyn and in Queens, and it's true in Westchester and on Long Island. it's a phenomenon, and the net rents on industrial buildings in New Jersey are better than the 3-story office buildings in places like Parsippany and things like that. So we love industrial. But in all commercial deals, you're worried about a diversity of tenants versus a credit tenant. So if you have a long-term credit tenant, you lend against that as long as the rents aren't terribly high. And if you have a diverse number of tenants, you figure there's always going to be another tenant to come along if one or two go out at a time. But you're trying to find a good distribution of expiration dates for the leases. In terms of retail, you're absolutely right. Every retail, there's still going to be a need for retail. Maybe it's not going to be the big box Best Buy in New Jersey it's equivalent of Route 10 or Route 17. What are you going to do with that? Maybe they'll make it a marijuana grow room, but that's not quite legal yet. But you know, we're looking at we like to see the performance of the retail. So in a shopping center, we want to see the sales of the anchor and compare that to the dollars and cents of shopping centers, see where the sales are. You like seeing sales above $1,000 a square foot. You look at the efficiency ratio, the rent compared to the sales, and for each industry, there's an index that you can say, you know, that's a good performing store, that's profitable, they'll stay. Or if the sales aren't so good and the rent's high, you know you're going to have a problem. Jim,
We talked a little bit. The concept that nobody's knocking down apartment buildings to build factories is absolutely the case. If you look at Hunts Point, I've been active in Hunts Point for 25 years. $75 a square foot, right, Vinny? To $200 for just like a box. And if you have a specialized, like a USDA quality place, you're talking $275, $350 a square foot. 5-7 years later. I mean, those are big numbers. For all the residential, every time I see residential property going up, there's got to be a doctor and a dentist. There's got to be a place to buy milk. And there's got to be a place to get the product to deliver to them. So that's why you see places like Hunts Point and the industrial sections of Yonkers not really going away, because you still have to have a place to store the goods that these people are buying. It's a different type of tenant, and Gardner referred to large big box stores. When I think of industrial or big box single tenant places, I'm thinking of 5,000 square feet. I'm thinking 10,000 square feet single tenants. Those really aren't going away. Most of the what we call commercial industrial, which are owner occupied, we're not seeing owner occupiers able to buy those buildings because investors are bidding the properties so high. And that's who's bidding these properties up, because people are looking like it. The cap rates are dropping, below 5 on industrial. That's crazy. We're wrapping it up. Vinny is either saying I'm doing a great job, or he's saying wrap it up.
I think that was for me. But.
We're very bullish on industrial. We're offering lower rates and higher LTVs on industrial than we are on retail or residential. That's what we think. The biggest investor I have, one of the largest clients at Webster Bank, only owns industrial. And he spent the last 40 years buying crappy properties in every crappy industrial area. And he's built a $200 million portfolio of properties that have gone way up in value.
Well, one more question, and that'll be it for the night. Gene. Oh, Gene.
Hang on, Gene. He or Gene.
I'm a professor at NYU, and one of the big things that we're moving our students to is entrepreneurship. And the buzzword on campus is startups. What do you guys feel about finance, helping these young kids with startups? And some of the concepts that they're looking at you may find totally bizarre, but I'm just curious, because I've been listening to the entrepreneurial, professorial staff talk about angel investors, angels, and venture capitalists. Nobody talks about banks. Can you comment on that?
I'm actually holding the mic, so that's the only reason. Jane, I'm assuming you're talking about you're talking about an operating company. You're not talking about a college graduate buying a building.
No, I'm talking about a group of kids who have an idea for a software product.
Okay.
Or a new widget.
So that's an operating company. That's a company that's they're gonna rent their space, or they're gonna operate in the cloud or a garage. That's totally different. There's a lot of opportunities. The federal government has not pulled back from SBA lending. Webster Bank, I know all the banks here do a lot of SBA lending. So yes, there's a lot of money out there. And we are lending, 10% down. Give us a great idea and a great resume, right? I think everybody's doing that.
There are organizations they can go to talk to people with their startups.
We're talking serious risk.
Yeah, and then
We're not taking
the level of that risk on top of what they can get obviously coincides with each other. But good.
Right. I think also, what you can also refer your students to, because they're looking at it differently. Traditional banks actually shy away from their traditional loans directly to startup companies. But we do have different products, like the SBA supports it. But also, I think there are other alternatives for them in seeking financing and utilizing different things like Kickstarter and crowdfunding resources, where I've been talking to a lot of younger entrepreneurs who are looking at their own investment groups and looking at those alternative resources. That's a very dynamic space right now for them to consider as well. So I would say look to the SBA program with different lenders, but also look out there for these new creative types of funding sources from the community.
I'd have to bring somebody from the bank who actually knew about this stuff. My customers are owners of real estate investments. So they may actually take startups as a tenant in their space, and I will not be as pleased to see a whole building full of startups because I want to count on the rent. So, and as far as startup lending in real estate, it doesn't really mix. And it's really a thing for SBA loans or more loans that come from people who would like to risk big and earn big. But we're not that kind of lenders. We're just collecting a small spread over the treasury rate.
Well, I would have to.
Before you say that, Gene, if you're interested, I'll give you my card. On the 26th, a week from today, in Federal Plaza at the SBA, I'm on a panel discussion it's called Meet the Lenders, and it's all about people looking for startups to do SBA lending. So if you want to send some of your students over who want to hear about how startups work and how to finance them, I'd be happy to speak to them. Mike Trainer will be there as well.
I'm a mentor to a project cardiovascular product, and it's got a great deal of potential. But when you talk to the venture capitalists, I mean, they're looking for a lion's share of everything. So the kids are early 20s, so they're terrified. They're really terrified. Finding money is tough, and there's a question of trust. Now, what you said, the gentleman at the end of the table, is surprising to me because there's a section of Brooklyn, Dumbo, they're referring to as Dumbo section. This is under the
Manhattan Bridge.
Yeah, and it's doing fantastic. And when you go inside there, and I've been there a couple of times because some of my students are renters, they're doing very well. So I'm not quite sure I understand why you're upset. The title of this talk, the title of the presentation is How Area Banks Are Adapting to Meet Industry Needs, which is why I'm here. Okay, so you're talking about a stodgy business and you're not focusing on what is happening now in the world of our young people.
I'd like to address this, and then maybe we'll have a conversation afterwards. My business is lending on commercial real estate and to making sure I get paid back. There are people who do this kind of lending. I try to step away from the risk because my earnings are destroyed. I am more leveraged. We are more leveraged than anybody here in this room. We borrow 94 cents of every dollar we lend. So, and I used to work for a guy named Bob Wilmers, who was the chairman of M&T, and he said, you know, interest doesn't pay principal, and if you take care of the downside, the upside will take care of itself. And that's what's happening when you're in a leveraged business. There are other people who go out and lend and will be happy with these tenants. They'll charge different rates. I mean, I won't even lend to a building that's got a WeWork tenant in there. And WeWork as a tenant. I think I think the technical term is it's a fugazi. So if anybody needs to know what a fugazi is, I'll explain after this. But I'm lending on more proven things. I leave the other aspect to people who do SBA lending, which we do. But SBA lending is a whole different business than commercial real estate lending.
Well, on that note, and it's an intriguing question because I would love to know who the banker was who first showed an interest and faith in a Bill Gates or a Wozniak and a Steve Jobs or whatever. So it's an interesting question. With that, on behalf of our president, Vinnie Mutarelli, and all the heads of the 6 families, if you're still here, or the 7 families, and my staff, Maggie Collins and Jeff Hanley, I want to thank you all for coming and participating, some on very short notice. And we'll see you, God willing, next month at another general membership meeting where we will have the county executive, George Latimer, address the association.